They didn't just shake the market. They tried to take something from you. Over the last 24 hours, silver didn't simply fall, it was deliberately pushed. If you were watching yesterday, you saw the damage unfold fast. An aggressive sell-off, an abrupt breakdown, headlines declaring the bull run dead. And in that moment, fear did its job. Your pulse rose. Your confidence was tested. You didn't doubt silver, you doubted yourself. That hesitation was the target. Because today, the market exposed the truth. Silver snapped back to the mid-70s in a single session, reclaiming nearly half of the prior day's collapse. That is not how a broken market behaves. That is how a trap resolves. Real crashes bleed slowly. Fake crashes reverse violently. What we witnessed was not a failure of fundamentals, but a forced liquidation event designed to transfer positions from emotional hands to disciplined ones. The mechanics are simple and ruthless. High leverage attracts precision attacks. Stops cluster at obvious levels. Algorithms know this. Institutions know this. So price is driven just far enough to trigger panic selling, just long enough to convince people the move is real. Once the selling pressure is exhausted, the reversal begins fast, unforgiving, and without warning. Here's the uncomfortable truth. If you sold yesterday, you didn't exit risk, you absorbed it for someone else. Markets require sellers to move higher. They manufacture fear when sellers disappear. And once that fear does its job, it's discarded without remorse. That's why today feels shocking. Not because the recovery is surprising, but because the narrative changed too quickly for emotion to keep up. If you're still holding, understand this clearly. You were not trapped, you passed the filter. Volatility is the cost of admission. The market doesn't reward belief, it rewards resilience. What happened yesterday was not an ending, it was a reset, and resets happen before acceleration, not after exhaustion. This is where understanding matters more than prediction. Because if you can stay rational while the market weaponizes emotion, you don't just survive, you position yourself ahead of what comes next. If this breakdown helped you stay focused, support the channel. Type 1. In the comments. If you held through the drop, 2. If you added on weakness, and subscribe, because the next phase of this move will be faster, louder, and far less forgiving. To understand why the rebound was so violent, you have to understand who panicked and who didn't. When silver dropped hard, the selling didn't come from long-term holders, it came from speculators. The tourists, the traders who borrowed confidence instead of building it. These participants trade with margin-tight stops and fragile psychology. When price moves against them, they don't reassess, they react. And reaction is liquidity. That liquidity is exactly what institutions wait for. Large buyers cannot enter quietly when price is rising. They need sellers, and when sellers disappear near highs, the market must create them. That's why the drop felt unnatural. It wasn't driven by new information. Mines didn't shut down. Industrial demand didn't vanish. Nothing fundamental changed. What changed was pressure. The market shook the tree. As price fell through obvious levels, stops were triggered in waves. Each wave fed the next. Fear accelerated selling, and selling validated fear. This feedback loop is powerful, but it is temporary. Because once the weak hands are gone, selling dries up. And when selling dries up, price doesn't drift higher, it snaps. That snap is what you saw today. The institutions didn't chase silver at 80, they waited. They let emotion do the work. Once contracts were dumped in panic, they stepped in aggressively absorbing supply without hesitation. That's why the recovery wasn't slow or cautious, it was decisive. When smart money commits, it doesn't test the water, it takes it. This is why calling yesterday a crash is misleading. Crashes destroy structure. Yesterday didn't. Support didn't fail, it was briefly violated and immediately reclaimed. In market language, that's not weakness, that's confirmation. It proves demand is waiting underneath, price not chasing above it. And this pattern matters because it repeats over and over. Every major bull market punishes late leverage and rewards early conviction. The pain isn't accidental, it's functional. It clears the path for the next move by removing those who can't survive it. If you're still here, you're no longer guessing what kind of market this is, you're experiencing it. And experience is what separates participants from professionals. Now we need to talk about the machines, because modern markets are no longer driven by human hesitation. They are driven by code, commodity trading advisors, momentum algorithms, trend-following systems. These are the dominant force in short-term price action. And once you understand how they operate, yesterday's chaos becomes disturbingly logical. These systems don't think, they react. They are programmed to sell when price breaks key levels and buy when momentum flips back in the other direction. Yesterday, when silver slipped below critical support, the machine switched from neutral to aggressive sell mode. Billions in futures were dumped automatically, not because the market was broken, but because the rules demanded it. This accelerated the fall, creating the illusion of collapse. But algorithms have a weakness. They cannot interpret context. They only recognize direction. So today, when price reclaimed lost ground and surged back above prior levels, those same systems were forced to reverse. Not gradually, instantly. They had to buy back everything they sold yesterday while simultaneously opening new long positions to follow the renewed momentum. This creates a double demand surge, short covering plus fresh longs, and the result is a vertical move that feels unreal if you're watching it live. This is why V-shaped recoveries exist. Not because markets are kind, but because algorithms are trapped by their own logic. They chase price both ways. And when sentiment flips faster than positioning can adjust, the machines amplify the reversal just as violently as they amplified the crash. This is also why emotional traders consistently lose to systematic ones. The machines don't feel regret. They don't second guess. They simply execute. And when they're wrong, they correct by buying more, not less. That's the irony, the same systems that punish late buyers reward early holders. If you understand this, volatility stops feeling random. It becomes predictable in behavior, even if not in timing. Sharp drops followed by sharper reversals are not signs of instability. They are signatures of algorithmic dominance in a thin market. And right now, thin markets are exactly what we're dealing with. Which brings us to the next layer of this move, liquidity bonds, and why silver doesn't move alone. Silver never moves in isolation, and anyone trading it as a standalone asset is already blind to half the picture. To understand why silver was allowed to run today, you have to look at what happened beneath the surface in the bond market, in liquidity, and in gold. Yesterday's sell-off wasn't born in silver, it was transmitted into it. The bond market seized up. Yields spiked, collateral tightened, and liquidity vanished for a brief but violent window. When that happens, everything gets sold. Not because investors want out, but because they need cash. Gold was dragged down hard, not due to weakness, but due to forced liquidation. Silver, being the higher beta metal, took the hit even harder. But here's the key. That kind of selling doesn't last. Overnight, the pressure eased. Repo markets stabilized. Stress indicators cooled. Whether through direct action or quiet coordination, liquidity returned. And when gold stabilized, silver was given permission to move. Gold is the anchor. Silver is the accelerator. When the anchor holds, the accelerator slams. That's exactly what we saw today. Gold stopped bleeding, silver exploded. This relationship is not theoretical, it's structural. Silver leads on the way up because it reflects both monetary fear and industrial demand. It crashes harder on the way down because it's thinner and more leveraged. But when the dust settles, it moves faster in the direction of the trend. This is why today's recovery matters so much. It confirms that the liquidity shock was temporary, a flash storm, not a climate change. The broader system did not break, and because it didn't, silver snapped back to where it belongs. If gold had continued lower, this would be a different conversation, but it didn't. It held. And that hold is the signal that the monetary floor remains intact. Understanding this correlation is your safety net. As long as gold remains supported, silver is not in danger, it is coiling. And coils don't resolve sideways forever. They resolve violently. Now let's talk about something the paper charts can't hide: the physical market. While futures were collapsing yesterday and screens were flashing red, something very different was happening behind the scenes. Physical silver didn't panic. It didn't get cheaper. In many cases, it got more expensive. Dealer premiums didn't fall during the crash. They rose. And that tells you everything you need to know. If price were truly breaking, physical sellers would rush to unload inventory. They didn't. They pulled metal off the market. That means the paper price fell below the level required to convince real holders to sell. In other words, the futures market detached from reality briefly. And when that happens, it never lasts. Industrial buyers understand this better than anyone. They don't care about 5-minute candles, they care about securing supply. Reports from the dip show aggressive buying in the low 70s, not from speculators, but from entities that actually consume silver. They stepped in early, absorbed selling pressure, and created a wall beneath price. This is how real bottoms form, not with euphoria, but with quiet absorption. The paper market pushed lower and found no follow-through. Sellers ran out, buyers didn't, and once that imbalance was exposed, the rebound became inevitable. This physical floor is what makes yesterday's move so important. It tells us that $74 isn't expensive, it's necessary. It's the price required to bring metal out of hiding. Below that level, supply vanishes. Above it, demand still exists. That's not a fragile setup. That's a squeeze waiting to happen. Technical damage from the crash looked dramatic, but it didn't last. The breakdown failed. Support was reclaimed. In market terms, a failed breakdown is a bullish signal. It proves the bears showed up and were overpowered. The trend didn't die, it hardened. As we move toward the final trading days of the year, this matters more than any headline. Because funds care about where price closes, not where it dipped. And right now, the structure is telling us something clear: the bulls are still in control. This brings us to timing, because timing is where structure and incentive collide. We are approaching the final trading day of the year, and in Wall Street terms, this is not just another session, it is Judgment Day. Performance is measured at the close. Bonuses are calculated at the close. Careers are defended at the close. And that reality changes behavior. Funds that are long silver have one objective right now: finish the year strong. They want the chart to look clean. They want the breakout to look undeniable, and they are willing to spend money to make that happen. This practice is known as marking the close. And while it's perfectly legal, it is extremely powerful. Price is pushed, not because of new information, but because incentives demand it. This is why today's rally is not random. It's the opening move of a year-end defense. After yesterday's flush allowing silver to close weak would undermine the entire narrative. It would raise uncomfortable questions from clients, so the response is forceful. Futures are bought, weakness is defended, the tape is guided higher. What makes this moment rare is alignment. Market structure wants a higher close. Fundamentals want a higher price to unlock supply. Momentum systems have flipped back to buy. These forces don't always agree, but when they do, moves accelerate fast. Short sellers understand this too. Anyone who pressed shorts into yesterday's breakdown is now trapped. Price reclaimed key levels too quickly. That speed matters. When a breakdown fails within 24 hours, it creates forced buying. Shorts must cover into strength, adding fuel to the fire. This turns dips into opportunities, not threats. But don't confuse strength with calm. Thin holiday liquidity means volatility remains elevated. Swings can still be sharp. The difference now is direction. The market has chosen it. The test wasn't about price, it was about resolve. And that test cleared the board. Now we shift from the immediate battle to the broader cycle, because what just happened didn't weaken the trend. It prepared it. One of the most overlooked truths in markets is that strong trends require resets. Momentum cannot rise indefinitely without releasing pressure. Yesterday's drop did exactly that. It cooled indicators, flushed leverage, and reset positioning without damaging the long-term structure. This is where the January effect enters the picture. Fresh capital doesn't chase overheated charts. It looks for strength that has been tested. With silver, back in the mid-70s, the asset is no longer stretched, but it is still trending. That's the ideal entry zone for institutional money rotating in at the start of a new year. From a technical standpoint, conditions are now balanced. The market isn't overbought. It isn't broken. It's coiled. And coils are where trends are renewed. What looked like chaos was actually preparation pressure being released, so the move can continue without tearing itself apart. Psychology confirms this. Fear peaked yesterday. Relief dominates today. But relief is deceptive. It tempts complacency. The market thrives on that transition: fear to relief to disbelief. Those who survive the fear are often shaken out by hesitation later. That's why understanding where we are in the emotional cycle matters. In true bull markets, dips are bought instinctively. That's exactly what we saw. The aggressive response to weakness wasn't accidental. It was learned behavior. Participants now expect higher prices and act accordingly. That shift doesn't happen in bear markets. It happens when a trend is healthy. The move toward 80 didn't fail. It paused, and pauses after resets tend to resolve in the direction of the larger force. With leverage reduced and demand intact, the path forward is clearer than it was before the drop. The market didn't break. It breathed. Now we look beyond charts and into flow because supply chains don't care about sentiment. As the calendar turns, the physical system tightens. Refineries slow output during year-end audits. Inventories are counted, not expanded. At the same time, industrial buyers prepare for a new budget cycle. This creates a dangerous imbalance restricted flow, meeting rising demand. January isn't just psychological, it's structural. Corporations reopen capital expenditure budgets. Procurement departments move from conserving cash to securing materials. Silver isn't optional for them, it's an input. Solar electronics, energy storage, none of it functions without silver. And when multiple buyers chase limited supply, price doesn't negotiate. It gaps. This is why the floor established in the low 70s matters. It tells us that available supply is already spoken for. Any new demand has to bid above existing holders. That's how price discovery begins, not with speculation, but with necessity. Globally, the pressure is even clearer. In several currencies, silver never pulled back. It continued printing highs. That creates arbitrage demand. Metal flows toward the highest bidder, and right now the global bid is rising. You cannot suppress a global asset in one market when it's breaking out in others. This is also where volatility becomes a tax. As price rises, swings widen, moves become faster and less forgiving. This isn't instability, it's scarcity asserting itself. Thin supply combined with urgent demand doesn't produce smooth trends. It produces air pockets and the spikes. Understanding this keeps you disciplined. Noise increases near inflection points. Those who confuse noise with signal exit early. Those who recognize it for what it is stay positioned. The market isn't becoming riskier. It's becoming tighter. As price advances, psychology becomes the final battlefield. Yesterday, fear dominated. Today, relief took its place. But the most dangerous emotion in markets isn't fear, it's comfort. Comfort makes investors stop paying attention to risk while volatility quietly increases beneath the surface. And silver is entering a phase where emotional discipline matters more than precision. This is where position sizing becomes strategy. If yesterday's move kept you awake, your exposure is too large, not because the thesis is wrong, but because volatility is the toll required to stay in the trade. The path higher will not be smooth. $10 swings will become normal. Headlines will grow louder, narratives will turn hostile again. This is not a flaw, it's confirmation. Strong trends shake participants repeatedly. They don't reward those who react, they reward those who endure. The goal is not to predict every swing, but to survive them without being forced out. That means anchoring your focus to what doesn't change. Your ounce count doesn't change, price does. As silver rises, attention will follow. Media coverage will increase. Political scrutiny will intensify. Calls for regulation, taxation, or intervention will grow. These are late-cycle symptoms, not early warnings. They arrive after the move is already underway. This is why patience remains the edge. The accumulation phase feels boring. The repricing phase feels violent. We are transitioning between the two, and that transition is uncomfortable by design. Those who can stay detached from the day-to-day noise, who understand why volatility expands as trends mature, will be positioned to benefit from what comes next. Because what comes next isn't subtle. Now we step back and draw the final line because every market cycle leaves behind a lesson, and this one is unmistakable. What you witnessed was not chaos, it was conditioning. The market tested resolve before rewarding patience. It exposed leverage, punished emotion, and confirmed something far more important than a price target. The trend is intact, and conviction has value. The strategy from here is not complexity. It is discipline. You do not need to outsmart every fluctuation. You need to survive them. As silver moves higher, volatility will increase, not decrease. That is the price of repricing an asset that has been suppressed for years. Sharp drops will occur. Violent rallies will follow. Neither invalidates the thesis. The lesson is simple. Focus on structure, not noise. Fundamentals are tightening. Supply is constrained. Demand is expanding. Monetary pressure hasn't eased, it has accelerated. These forces don't resolve quietly. They resolve decisively. For those who held through the fear, this was a proving ground. For those who panicked, it was tuition. Markets don't apologize, they educate, and the education just got expensive. As we move forward, your edge is clarity. Know why you're positioned. Know your risk tolerance. Adjust size if needed, but do not abandon logic for emotion.